Live streaming is on.
All right. Good afternoon, everybody. Event Trader here. And I am, of course, joined by option trader Brandon Mars for the option playbook. Brandon, how are you doing today?
I'm great, Gavin. How are you?
Doing good, doing good. Just kind of watching this market melt higher like everybody else. Certainly be interested in your take. I know there's been a few odd price actions going on that you've been paying attention to today. Uh, Pretty choppy action since over the last hour or so. So I kind of be curious to hear what your take is on the markets here.
Yeah, I'm kind of in agreement with what you said earlier. It almost feels like we should be like looking for some shorts out there, but it's just so strong. It's been really, really hard to bet against, and it almost felt like we were going to get a little bit of a breakdown earlier today, and then all of a sudden that Microsoft news came out, and unfortunately killed my NVDA trade, and that took off. Microsoft took off. Meta started seeing some pretty choppy action. Even had some stocks like Zoom that had some news out on it that was bouncing around everywhere. So, yeah, kind of a slow melt up. It almost feels like we should be shorting, but it's just the computers seem pretty set to buy right now. So I guess you got to be cautious with that until we really see a turn here.
Yeah, that's the one thing. Like, I mean, as you said, I was talking about this morning. You feel like you should be shorting, but there's no openings. There's no liquidity shortfalls or anything that seem to be occurring. Every drop's being bought up by the people that have been on the sidelines. Is my assumption that are just trying to own anything at this point. Definitely a FOMO feel to everything that's going on out there, and that's a tough environment to short because as soon as that setup starts coming, a lot of people eyeballs are on it. And then once you get a crowded short and a FOMO trade coming in, that usually is a bad prescription for trying to watch the market fade, right?
Yeah, exactly, and that definitely happened earlier. It was interesting. You had stocks like Microsoft and NVIDIA that were actually struggling a little bit today. Amazon's another one. So you had some of the big tech under a little bit of pressure. Nothing much after the run they've had, and yeah, you were kind of looking at it, and you kept getting those flags earlier, and it looked like it was going to maybe roll, and then all of a sudden it's just higher and higher and higher. So I don't know. It maybe feels to me like it's slowly running out of gas, but I'm not saying, hey, go short the market or you know, get your 401k out of the stock market by any means. But yeah, I wouldn't be shocked if maybe this afternoon we maybe see a little bit of a rollover and some profit taking. It wouldn't shock me, but I'm not going to bet the farm on it. That's for sure.
Are there any specific sectors? I know you follow the tech names pretty closely. Is there any sectors that you're kind of paying a little bit of closer attention to that you're seeing some potential opportunity?
Yeah, I mean the industrials for the most part have been looking good. I talked about Caterpillar and Deere recently, and I know you and I were just talking about Boeing. I'm a little surprised at the strength in that one. I
The
thought
weakness, you
that.
mean?
I'm sorry.
The in Boeing, the weakness, you mean, right?
Yeah, the
Yeah.
weakness in Boeing. Yeah, I'm a little surprised by that. So, you never know. Microsoft was read this morning, and then all of a sudden there was news, and Boeing likes to act on that news. So, who knows what's going on there? But interesting to see a Boeing down 1%, and then you've got Caterpillar on the flip side up 2%. So, the last time that happened, actually, I ended up picking up some options on Boeing, and that was around the delivery time. So it probably bears watching. And, sure enough, as we're talking here, right around that 210 level. So be interesting to see whether it breaks down or bounces off of that.
Yeah, Boeing is an interesting one for me as well because I just get the sense that somebody knows something because we had that run up to 222 last week, and since then it's really just been pretty much faded straight down while the market's been going up and industrials leading the way. And then you get that Lockheed Martin earnings report this morning, which I felt was pretty solid. I thought that could work well for that whole aerospace and defense area here. Of course, Lockheed Martin's also gotten a nasty reversal going on too. So I don't know. It just feels like something is going on in that ITA space. I know it's that's down 1% here as well. We got that slipping below its 20-day moving average. So I don't know. Maybe there's anticipation of Putin throwing in the towel or something, but something seems to be up with that group there. That I haven't seen any downgrades or anything notable like that. So
Yeah, neither have I.
it's an area that we're going to have to keep an eye out on because, like we said, I got it down 9% on the day. One of the worst performers, utilities, real estate, and the social media names are the only things that are performing worse on the areas that I watch. So definitely worth keeping an eye out on there, especially since we've seen so many different stocks and different sectors and even indices holding that 20-day moving average here. When I start seeing one slipping below it, that definitely is going to catch my attention.
Yeah, I mean, anything these days that you find trading below the 20-day is a little bit of an anomaly. So, I've talked about that a couple times with like Google. I think it's back above it now, but for a while there, that actually dipped below its 20-day, which was, I don't know, I guess unheard of in the world of big tech. So that's definitely something that always catches my attention. Something like a Boeing it's kind of an interesting spot because it's now kind of sandwiched between its 50-day and its 20-day, which, if you're playing options, just I guess a little tangent here. If you're playing options, you need your options to kind of get moving, depending on the stock to make some money. So sometimes when you get caught between those moving averages, you have that potential to maybe play a little ping pong. So, for an options perspective, that might be a little tough until we get the further direction. But
Do you
once it
try to play
finally
straddles in
decides.
that situation at all, Brandon? Or
Oh, I'm sorry.
what would you play? Would you try to play a straddle if you're starting to see that pong coming about?
Um, in a Boeing, a straddle might be interesting just because it probably means there's some sort of news kicking around out there. But I only really do a straddle or think about one if I know of some sort of catalyst. So, if Boeing had like, a few weeks back or whatever it was, the air show coming up, or they had some sort of delivery announcement or contract that they were up for that would maybe make that big move to the up or downside. But when I'm not aware of any particular event, it's a little tough because I just feel like that's a recipe for kind of bouncing between those moving averages and then potentially killing both your call and your put option.
All right. Well, we'll definitely have a little bit more on straddles coming up later on in the show. But let's talk about some of your recent trades here. It's been pretty quiet for you this week, Brandon. So you had a specific reason for that. So you want to just talk about the environment that we're in right now and why you've probably been a little bit more quieter than usual.
Yeah, I mean, there's definitely been some good trades out there, that's for sure. But it does feel, despite the indexes being up so much, it definitely does feel a little choppy on some of the individual names. Some of my usual big tech traders yesterday were pretty flat for the day. And, just from an options perspective, you need those things to move. So I didn't see a ton of setups that I liked. And, kind of like we talked about at the beginning, the market's strong and everything. I haven't been finding as many chart setups that I've loved, where I just kind of am like, all right, this thing's kind of extended, but I don't want to bet against it. It's sitting here. And, I just kind of start to get like 5 or 6 things on a chart and it just makes me not love them. So, rather than, destroying myself at the beginning of the week, just trying to, take my time and wait for the right setups.
All right. So the trades that you did take so far, you had NVIDIA puts out there. That was just my assumption, dipping your toe in the water just in case there was going to be a roll.
Yeah, I just decided I would go and torture myself and try and buy a put on NVIDIA.
Let's just go after the strongest name out there, right? Let me ask you: does the waiting that's coming up here have an impact on why on that? Or is that something that you're taking into consideration, or was this purely just looking for some profit taking, given the incredible momentum this has had really all year?
Yeah, so for me, if you look at the reweighting, it's funny you say that. Obviously there was some news here, but all right, Microsoft's up 5% and NVIDIA's up 2.3. It's like, what reweighting are you talking about in a way?
Yeah, right.
Um, but no, I mean, that was definitely something that I was mindful of this week, but it's kind of like, where is it? For me with NVIDIA, if you look at the daily chart on Friday, that just seemed like a little bit of a blow off top. You had that long upper wick above the Bollinger Bands, pretty high volume. I want to say not quite double, but like a 50% increase from days before. So that just felt like a little bit of a blow off top. Thought we might see a little bit of profit taking. Had an inside day yesterday. And then I was just watching it today, and it was kind of hanging out at that 460 level. It actually, surprisingly, every time it kind of ticked up, I saw it get beat down a little bit. So I kind of thought something might be there. The market at the beginning of the day was feeling a little heavy, and I was just looking for a quick move to the 455 area, maybe 450 if real profit taking kicked in. And then unfortunately, I think it was getting beat down today because somebody knew some news was coming. So I was on the wrong side of that one, unfortunately.
Yeah, always tough when you have that sense that somebody knows something's up, right? Definitely,
Yes, unfortunately.
definitely makes you a little bit nervous going on there. Like, what was the one we were talking about last week? Where was it Activision? Right? Didn't somebody buy a slew of Activision calls right
I
ahead
don't want to
of
say
that
there was
ruling or something?
suspicious call activity, but slightly suspicious call
Well
activity.
timed, impeccably timed, we'll call
Yes.
it.
Very
So
well timed.
yes, and then we got Amazon out there, which you held those puts overnight. You banked some pretty nice profits this morning. Are you still involved in Amazon?
I am not. And the reason is that if you're on the daily chart on that one again, I'll kind of
Yeah,
walk through why I'm not in that one anymore. So if you look on Thursday, you had like a hanging man candle, and then Friday you had a shooting star candle, and then yesterday you had an almost bearish engulfing. It missed it by a couple of pennies. So you kind of have three straight candles that are a little bit of a flag. And then it kind of looked like it might just roll over and kind of test that small gap that it has from the end of last week. So I thought, again, just a quick trade, not a name I wanted to bet against for very long. And it rolled over and went down to that 131.5 area, which is kind of like the top of that little bit of a triangle that it had from, call it the end of June through beginning of July. So once it came into that area, I kind of figured with the strength in the market and the strength in that name, that it would probably find some support there. And yeah, had a nice bounce off that level. And so that's why I got out. I mean, in hindsight, it might have been, a decent call opportunity, but it didn't seem like the strongest name out there to me today. So I didn't flip over.
all right. Anything that you have on your radar at all?
Yeah, I'm kind of actually been kind of getting some arthritis in my wrist here, using my mouse, trying to just fly through some of these charts today to find something. Yeah, I mean, between that Microsoft news and kind of throwing some of these algorithms out there, and again, I don't want to necessarily go and bet the farm and bet against this move right now, but it's maybe feeling slightly weak to me as we climb. It just, we got the choppy designation today, and I just wonder if we're going to get a little bit of a rug pull here into the end of the day. So I'm kind of struggling that I don't want to necessarily hop in with calls, but I don't want to also necessarily hop in with puts. So just kind of playing it out for now, and we'll see if we maybe get a little profit taking here into the close.
Which is always one of the most difficult things for traders to do, but just understanding when is a good trading environment and when's not. And you're always look, you can make money at any point. There's definitely going to be individual names that you can make money at any point, but certainly understanding when's the time to press on the gas and when's the time to kind of hit pause and wait for your setup. That's probably the toughest thing to do as a trader, because there's always that element of, wow, I kind of feel lazy here, I'm not trading anything. But I mean, just the idea of trading for the sake of trading is where I think a lot of people get beat up on, right?
Yeah, and I think especially on the options front, because once you kind of get into the groove and you do start to hit some good trades, frankly, you kind of get a little bit of the greedy mindset, because you're like, wow, I can make this much with options, but you can also lose that much with options. So, for me, at the end of the day, I kind of only hate getting out a couple of ideas. And again, I don't know if I feel lazy, but I feel like, yeah, maybe a little lazy. And,
Yeah,
I want to be
and I'm not calling you lazy by any stretch of the imagination. I know you're busting your hump over there. It's just I'm saying the mindset of trying to get
yes.
out of the idea that I kind of feel lazy here. I'm not doing so. I know it happens with me. If I don't have a trade out there, I'm like, they're probably thinking that I'm playing with my dog over here. you know. And I'm like, maybe I should fire a trade just to send a trade out. Next thing you know, you're down $100 like that. You're like, oh, why'd I do that?
Yeah. And, for me, actually, one thing as far as trading options, I definitely have a little bit of that FOMO and the thought of the laziness. Yeah, no, I have that every day that I'm not, really actively trading. But, one thing for me is I actually got really happy at the end of yesterday because I'll admit in the past, especially as a new options trader, discipline can be very, very hard. And I've had times that I've burned myself when I was a new trader where I just didn't have the correct discipline. And that led to, 20 worthless options contracts at the end of the week. And it really, really hurt. So for me, I almost give myself a little bit of the pat on the back for having that discipline these days. It drives me a little crazy and I get a little bored, but I give myself a little pat on the back to not beat myself up too much.
All right. Well, let's turn to our primary topic for today, Brandon. That could open up some potential trading opportunities because, as we know, there's a lot of earnings coming down the plate here. One of the things that I always talk about during earnings is the first week and a half tends to be a separate beast from the regular market. And I know Brett's another one that always talks about how he never trades for like the first week and a half of earnings. We're getting all those financials out. We start getting a first glance at some of the big tech players out there. And you also get a few energy names crawling out and stuff like that. But it always takes a little while for the ebb and flow of earnings season to start really showing itself, where people get comfortable with some of the concepts that we were talking about going into it. This one, the health of the consumer, margins, of course, and just the overall economic environment playing in. So far, the early returns have been positive, but it is a tough time to trade options, Brandon. And you in the notes that you sent me, you talk about two of the primary risks for trading options around this time frame. So you want to get in on that?
Yeah, so the two main, I mean, there's obviously more than two, but the two that I kind of think about when trading options around earnings is you have to pick what direction the stock's going to go in. So, that's hard enough as it is. So, let's take Tesla. We got to figure out the delivery is going to be good, margin's going to be good. Like you just said, is the consumer going to be strong enough to keep, buying Teslas for the rest of the year? So that's hard enough in itself. And then on top of that, you also need to find a stock that's going to move enough to cover the higher premiums. So for me, and again, I should have mentioned this right at the beginning, I rarely trade options around earnings anymore. I kind of got tired of picking a stock correctly, but it only moved 5%, so it didn't cover that high premium, and I ended up losing on a winner. So for me, I just stopped doing it. There is a lot of money to be made. There's also a lot of money to be lost because you are basically gambling on the direction of the stock. But those are the two main risks that I, think about when going to pick an option around earnings.
All right, and we're going to go in now. Let me give me a quick second here. I'm going to change over the screen, and we're going to go into a nice report that Carmine, actually, everybody on audio knows Carmine from our geopolitical discussions, but he's also a very busy man in over on the in-play page, and he puts together a really nice report for it's a special report also found under the options ticker, and what he does is lay out um, some of the primary, hold on a sec, some of the names that are coming up, and Brandon's going to kind of teach you how to read this, and as he's talking, he'll explain, what he just meant in terms of taking a option in a play that just doesn't go over the premium, doesn't trade enough over the premium to put him into the money, and therefore, while still being right, he could still lose money, which is never an aspect that you want to look at. But if anybody wants to follow along, I'm going to have it up on the screen. You could also do a search in the ticker symbol for option X. And this actually was something that Carmine posted back on July 14th. So, Brandon, just kind of take us through this comment and how people should be reading it and interpreting it in terms of option trading and overall price action expectations.
Yeah, so I'll use Netflix just because that's probably the biggest name on there, and it's towards the top. So the main things that I would look at there, so Netflix, so implied volatility is, we'll call it roughly percent. And historical volatility is roughly 25%. So basically what that's saying there is you've got, double the implied volatility, which in theory means you're basically going to be paying double for your options. So very, very common occurrence that you would see around options. Happens with almost every stock out there. The big tech names, the volatile tech names, will tend to have a higher premium heading into earnings just because those are the ones that tend to move the most. So that's basically what you're going to end up paying for, your call, your puts. You'll usually end up paying a little bit more on the put side just because that's usually how they generally speaking work, just because they're insurance. Although in a case like the market we're in, you might be seeing a lot of people going into the calls, so that might be a little different in each case. And then I'm going to move over to the one-day event volatility because that's really where I would concentrate. Generally speaking, the implied volatility, it's just going to be higher around earnings. It's just a matter of just how high and basically how much does Wall Street think that this thing's going to move in one way or the other.
Brandon, let me ask you one quick question on the metrics that you just mentioned. So when you're saying a percentage difference between implied and historical volatility, and it's at 100%, and we see one day move based on historical volatility. So are you saying that the implied move there would be $76 basically for Netflix? Is that how it's kind of calculated?
That is what I'm seeing here. I did not do that math prior, but yep, that is what I'm seeing here from those quick numbers.
So
Yes.
basically, you would need this stock to move $75 or so just to even get into the money.
Yeah,
Yeah.
pretty much.
And,
Um,
and that's the point of this. I mean, hey, Netflix has some big earnings moves, no doubt about that. But that seems pretty absurd, right?
It is, yeah, and that next column too. You've got the one-day event volatility. Look at Netflix. You got 9%. Tesla, you got 8%. So, to your comment, you basically need those stocks to move that amount of percent before you even really start making money. So that's kind of the area that I got a little frustrated with. All right, I'm going to go buy a Netflix call, in a past quarter, and all of a sudden they kill it on subscriber growth and the stock's up 7% and I've lost on my call. So that can be a little frustrating, because you're taking on that risk, and it can be a lot of risk for a little return. Now, if you hit that right, and this was a comment I was going to make a little later, but I'll jump on it right now. You have those quarters where, I don't know, a few years back or a couple quarters back too with Meta, you had one time that it was up, or down like 25% a couple years ago. This past quarter, or quarter or two ago, I can't remember what it was, but it was up, 15, 20%, whatever. Those sometimes turn into 20x, 50x trades because they really got moving. And you're going to find those out there. And if you hit them, that is great. But for every one of those, you have a situation where you go into Netflix and it only moves 7% and you just don't make any money on it. So yeah, those are the two main columns that I would really look at. There is basically how much this stock needs to move in order to make money.
And if anybody's looking there, you'll notice that Carmine actually organizes this by the one-day event volatility. He doesn't have this in an alphabetical order or in chronological order or anything like that. He's using this one-day event volatility to kind of highlight it. So basically, Brandon, how you'd be reading this page is the names up at the top. They're the ones that really need to move pretty aggressively in order to have any shot at getting into the money, right? So would you kind of automatically be striking off the top section of this in terms of playing for options?
I mean, not necessarily. I mean, again, just knowing your risk that you need that move, because on the flip side, you're going to have other stocks that are going to be, I haven't looked fully down the list, but my assumption down towards the end of the list would be more of your blue chip stocks. So, I don't know, a JP Morgan, let's call it, it might have a 4% implied volatility. So, I mean, still, that's a big move for a big financial company. So yeah, like Johnson and Johnson, there's a good example, 3%. So I mean, that's not an astronomical move, but that's a decent size move for a stock like a Johnson and Johnson, just because it's a blue chip. So you got to kind of take that with a little bit of a grain of salt and kind of know the characteristics of your stock. So, if all of a sudden, for some reason, we saw Netflix at the bottom and it only had a 3% implied volatility, well, that would say to me that maybe there was some sort of mispricing, maybe there's some opportunity there. And that's the type of stuff that would intrigue me. Wall Street's pretty good at pricing in these options. They're surprisingly good at it, actually. So you don't necessarily see those things popping up all the time. But, just because it's at the top of the list doesn't mean, to necessarily take it off right away.
All right. I'll just ask a couple of random questions here. So Schwab, for instance, this had a 4%, right? Stock's up, was it 9%? I think it is here. Where is it at? 12% today. So that would have been an obvious big winner in this scenario, correct?
Yeah. So the number I'm going to give you right now, you got to take with a little bit of a grain of salt, just in case anybody did trade Schwab options. The timing of this is pretty critical to This is a hypothetical. If you were to enter into the calls basically right at the close yesterday, and you were to have held them to, as we speak, I mean, you're talking 900% returns on some of the options. Again, it depends on which strike you did. The further out of the money you went, the better you would have done in a case like this.
What about something if you're looking at? So let's take a look at SLG here. SL Green. This is, of course, the REIT play. A lot of real estate in New York. A lot of people have been concerned about this. I don't have the numbers in front of me, but it's around a 64 million float and a 25% short interest, right? It's got a 7% implied 1-day vol here, right? Is this something that you would maybe look at if there's a ton of short interest involved that might have a little bit of a better chance of getting above this 1-day event volatility?
Yeah, I mean, anything with the short interest, I mean, that's where you make your money, really, is if you find a stock like that and they knock it out of the park, and the shorts are just, you get that usual barrage of buying that pushes the price higher. So something like that is interesting, but at the same time, you got to, I guess, kind of tell yourself, well, there's a high short interest in the stock for a reason. And like you were saying, there's some potential hair on the commercial real estate world right now. And, I actually used to work for a company, and we used to raise money for New York City real estate, and SL Green was probably our top competitor. And, the New York City office market, it's got some issues to it. And if those come out, well, there's a reason why all those people were shorting. But yeah, I mean, those are the explosive moves that you love. If SL Green came out with some great numbers and all of a sudden the shorts just rushed to the exit, that's where you could really make some good money.
All right. And two numbers that are just kind of jumping out from this SLG too. It looks like it's probably got the highest historical volatility rate, which what would that imply in your world, Brandon? That's 77% compared
Yeah,
to a 24% for Netflix.
that's pretty high for SLG, isn't it?
Yeah.
That's really high.
Yeah, especially for a REIT, which tends to be
Yeah.
pretty boring for the most part around earnings, I would think. And then, this is one of, you can see that there's a number down at the bottom, a few down at the bottom, but this is minus 20% the difference between implied and historical volatility, as opposed to 100% for Netflix. So those numbers seem a little bit off from what we were talking about before. So that's kind of why I was just curious about this SL Green, because I know this is one name that I've got on my radar for this week.
Yeah, that's kind of interesting. I mean, I know it got kind of volatile with some of it had some headlines and stuff recently. So, I guess in a way that might create some sort of, I don't follow that stock a ton just because I don't trade options on any REITs, but that would potentially create some sort of arbitrage type situation when you see something like that. Or what that could maybe tell you is that the news has been baked in, and that maybe Wall Street isn't really expecting any sort of, fireworks to the upside or to the downside in SLG.
Yeah, and just looking at the price action today, looks like the shorts are on the back foot here a little bit as this pops back above the 20-day moving average, and it's shifting up by this 33.69 area for potential breakout. So again, keeping this SLG on the radar is a name that I pointed out at the beginning of the week. Some interesting price action in this options volatility, something to be watched. Any names that are popping out to you by chance on this list, Brandon? Here, not necessarily for a trade, but they seem a little bit off that you might keep an additional eye on.
Yeah, the SLG one is interesting. I actually came from the REIT world. That's what I actually used to do, but I don't watch them anymore just because they don't really trade well necessarily on the options front. Nothing's really, the Tesla numbers seem a little surprising to me.
You would have thought they're a little bit higher.
Yeah, the implied volatility would usually be a little bit higher on something like that, just because it's had such a run, and I mean it's Tesla in general, so that's a little intriguing. I'll probably take a little bit more of a look into that one a little bit later.
Okay. Well, now, like you said, you don't like trading options going in to earnings, but there is one thing that you've noticed, one scenario that you've noticed towards the end of the day. So I'd be curious as to hearing your thoughts on that.
Yeah, so I'll put a very big asterisk grain of salt onto this particular idea. But one of the things that I have found from watching options is, if call it 1 to 2 minutes before the close, if a stock is reporting either earnings after the close or the following morning, if all of a sudden you start to see big chunks come into that particular option chain, and I'm talking like single blocks of like 5,000 plus options, and you see a few of them, that has been one thing that has, I guess we'll call it, intrigued me in the past and has worked out well, because it has for somehow dictated how the stock has ended up going. Again, very big grain of salt on that one, because you're making a split decision with 1 to 2 minutes to go in the market. But that is one thing that I've seen in the past that I have jumped on that has worked well for me a couple times.
Okay. Now you do also in your notes mention one huge benefit for using options during earnings. So you want to talk about that?
Yeah, so I think one of the best benefits is you have a defined risk. So at the end of the day, if you're, since we're on, Tesla here, I'll just pull up one of the options here. Let's just say we're bullish on Tesla, and we're going to go in and we're going to buy the 300 call strike. It's just under $8 right now. So, if you go and buy one contract, you're going to end up paying $800 for that. That's your risk. That's the most that you can lose if you go into the Tesla earnings. So if you go and buy Tesla shares, in theory, your loss is unlimited. Now, I do not expect Tesla to announce bankruptcy or anything like that, but in theory, Tesla stock can go to zero. So you do have unlimited risk there if you take shares into earnings, versus the options where you know exactly how much you can lose in the worst case scenario.
All right. And then you also have one other idea for trading options that I haven't seen you put any on the site, but you mentioned straddles as something that is a potential way of playing these.
Yeah, so I haven't done a straddle in quite some time, but as I was putting together this segment, I thought it'd be at least good to share the idea. So this is one way that some people do play earnings. So a straddle essentially is designed to profit from a big price change, either up or down in the underlying stock. So basically what you do with a straddle is you are buying, and it's going to be the same expiration date. So basically what you're doing there is you're going to take a stock like a Tesla, and you're going to basically say to yourself, I don't know whether Tesla is going to just knock it out of the park on, their margins and their deliveries, and it's going to skyrocket, or they're going to say, you know what, the economy is slowing down and people just aren't going to be buying our cars. And either way, in a way, you kind of don't know, but you think that there's going to be a big move. And part of the reason I wanted to bring this particular strategy up is, with some of the tech names out there, I'm not going to guess which one, but you got to imagine with some of the moves that some of these are going to come out and say something great about AI and they're going to soar, and somebody's going to come out and they're going to not have the greatest outlook, and due to the run up that they've had, it's going to get smoked. I'm not going to guess which one. I frankly have no idea. But in the case of a straddle, if you think that that might happen, that is a way to potentially profit from a big move in the stock. So just for easy math's sake, let's just say we had a stock that was trading at, call it 100, and you were to buy the 100 strike put and call each for $1. So your total cost is $2. Your break even point starts at basically 102 and a cent, because again, your strike's at 100. You've got $2 worth of premium that you paid for. You need the stock to move either to north of 102 or below 98 to cover your premium and to start making money. So again, this is a strategy that needs to have a big move. A good example would probably be JP Morgan. It was up, I think, and Gavin, you probably know a little better than me. I think it was probably up 0.5% off of its earnings report.
Yeah, then it rolled back over, though, popped up to like 152, rolled back to 148, and now it's obviously higher up here.
Okay, so in the particular day of the earnings, just in this particular example, it didn't move a whole lot. So a straddle there, you would have potentially lost on both the put and the call. And again, kind of like Gavin just said, there's, it moves up, it moves down. At certain times, you could have potentially closed out the calls or the puts for some profit. But essentially, the theory behind the straddle is that moves 2% in a day to be up like 7% in the day after earnings. Maybe something similar to like a UNH. That might have been a good example, because that's an outsized move for a stock that size. So one of the risks is that your stock just doesn't move, and all of a sudden you're stuck with both a call and a put that would most likely expire worthless. But if you're expecting volatility, this is a particular strategy that you can use to play both sides of the table.
All right, Brandon, anything else on options around earnings season here then?
Yeah, the last thing I wanted to mention was something known as volatility crush. So essentially what happens we had talked about this at the beginning, where you have those implied volatility and historical volatility numbers, and your implied volatility, generally speaking, gets driven up to pretty high levels prior to earnings. So when your implied volatility is going up, that's driving up the price of your premiums that you pay for options. Well, once the news is behind us, then Wall Street basically starts to price in, the reaction to the news and what happened. And you have the event that is now behind us. So basically what happens is your premiums will start to come down. And what happens when your premiums come down is, or your implied volatility comes down, is your premiums start to come down. So that's the type of case that you see where you might enter into a call. All of a sudden you think like, all right, Netflix is up 5% in the pre-market. My option's going to kill it. And then all of a sudden the market opens and the implied volatility drops. It's still going to be volatile because there's going to be post-earnings trading that's going to get a little wild. But generally speaking, your premium is going to come down. And that's what happens of why sometimes your calls or your puts don't make as much money as you would think post earnings, because the move just isn't big enough to basically cover that premium that you entered into. So volatility crush happens.
Are you of the mindset then that if you do get a move, say it's an after hours, and you do get the move, that you want to close that as soon as possible? Is that basically what that sets up?
I've talked a lot in my notes and stuff about how I'm a big fan of like Amazon this morning. I mean, that's a great example. If I had held that Amazon for any longer, I would have just basically had diminishing returns. So I like to at least take some sort of profit and take advantage of that. Now, flipping back to what you had asked for about earlier, if all of a sudden I was in a big tech name, kind of going back to the SL Green scenario, if all of a sudden I was in a big tech name that had, 20% short interest and they had some report that knocked it out of the park and they talked about whatever new AI they're going to be doing and the chart looked good and I thought that had some room to run, that's the type of scenario that I'm a little bit more likely to hold on to something. I'd probably at least take a little profit out of the gate just so I didn't lose it because that's just the worst. If you pick the stock right, it soars and then all of a sudden it just fades and you lose on what was really in theory a good call by you. That stings. So
Yeah. Nothing could be more frustrating, and it sounds like you've had that happen to you a couple of times, which is why you don't like to trade earnings or options around earnings.
it can be very frustrating and you get that pre-market or after hours activity and in certain cases where a firm like a Meta comes and knocks it out of the park, you might get some follow through into the actual market. But I think on any day, earnings or not, you see that after hours pop like, oh wow, my stock's up 3%, and then it opens up the next day and it's down 2. So
Yeah.
yeah, I always try to not get ahead of myself until the actual cash has been removed from the option and returned into my account.
No, makes sense. Makes sense. All right, Brandon. Anything else at this point then?
No, I think that about covers everything on the list today. And yeah, I guess we'll just continue to watch this market melt up a little bit higher here.
Yeah, keeping an eye for the roll, but as Brandon said, not a lot of reason. We're not being given a lot of reasons to get too aggressive on the short side. That's for sure. So going up too high too fast is never really a great reason for shorting. Is definitely a lesson that people should know.
Yes, I'm unfortunately well aware of that,
Yeah.
that as well.
Yes, I am as well. Momentum could be pretty aggressive at all times. That's for sure. So, all right, Brandon. Well, I'll tell you what. We'll let you get back to the desk here. I'll also return here to the desk. We're going to shut down audio just for a couple of minutes. Then we'll be restarting it and take a look at the afternoon action. I'll be posting the option playbook follow-up here, the replay of it in a couple minutes. If anybody's got any questions on anything, definitely feel free to write in, and me or Brandon will be happy to take a look at them. So, Brandon, as per usual, thanks for taking the time to chat with us today. Always find out a lot of good information from you, and you delivered once again, so appreciate it.
All right, thanks, Gavin. Appreciate it.
All right, have a good one. All right, again, we'll be just shutting down audio temporarily here. I'll be back up in just a couple minutes.